welcome everyone to today's Employment Law Lunch and Learn presented by Kelleher and Holland. We're happy to have you join us for this presentation on Employee Stock Ownership Plans, or ESOPs, a powerful tool for business succession, employee retention, and tax efficiency. Whether you're a business owner exploring exit strategies or an advisor guiding clients through succession planning, today's session will serve up slices of valuable insights into how ESOPs work and their financial benefits. So as I said, serving up slices for our discussion today are Robert Holland and Maura Ann McBreen. Bob is co-founder of KH, and with expertise in estate planning, tax and asset protection, and corporate law, he offers a unique blend of legal and financial acumen as both an attorney and a CPA. Maura Ann has over 30 years of experience advising some of the nation's largest employers and specializes in employee benefits and executive compensation. So let's dive in. Bob, let's start by simply defining what an ESOP is.
Thanks, Amy. And hello, everybody, and thanks for taking the time today to join us and go through everything here. And today we're talking about ESOPs, or employee stock ownership plans, which at the end of the day is a qualified retirement plan that invests in employer stock. Or in other words, an ESOP generally would look to invest in or buy C corporation or S corporation stock from shareholders. To note, it's not available to partnerships or sole proprietorships. And why are we talking about ESOPs here? At the end of the day, it's an option for business owners as they're thinking about their succession. So if you or if one of your clients or somebody that you know is thinking about selling their company one day, in a lot of instances, ESOPs don't really get much thought. And this isn't the answer to every solution or every succession plan by any stretch. But in a lot of cases, it's at least worth thinking about. And I think it's an area that a lot of people maybe don't really know, or maybe have had much exposure to in the past. And so we're hopeful today that, at least you walk out of here with some good pieces of information and a little bit more awareness of what an ESOP is and how they work. And this picture here is just trying to tell the story of on how an ESOP comes together, how it's funded, and how do the different parties all play out. But like I said, let's say I'm a business owner and I'm thinking about selling my company. So I'd be that selling shareholder down there in the bottom left-hand corner. I've got my existing company, which is in the top right corner. And I say to myself, well, how would this ESOP work, and how would it fund, and how does this, come together, like I said? Well, the company would go to a bank and get a loan. The bank would loan the money to the company. The company would take those loan proceeds and do an internal loan to the ESOP that we set up. And the ESOP would take those proceeds and buy out the selling shareholder. So that's how the ESOP invests in those C corporation or S corporation shares. The ESOP indirectly through a loan from a bank, a third-party lender, gets the liquidity to buy out the selling shareholder. The ESOP then would owe back the company, and the company then would owe back the bank. And the participants in the ESOP would then be the employees of that company. So really, this is a potential exit strategy where an ESOP can be used to, maintain some control, keep the employees engaged, that continuity, and a bunch of other factors, which we'll talk about here today. But I think this picture does a decent job of, creating an example and a little bit of flow of funds here of how this will all come together. And we'll get on the detail here and a couple other things to consider. But with that, I'll drop this off to Maura Ann.
All right. I wanted to mention that with respect to that picture, one thing that the banks don't like is to pick up fiduciary liability. So that's why they would prefer that the company engage with them, and then you do a piggyback loan to the ESOP trust. And that's why so often you'll see a structure that is basically redundant, and that you have the contributions being made to the bank to pay off the loan through the trust. Okay, so if we go on to the next picture, the next slide, why consider an ESOP? As Bob mentioned, it does create an exit strategy allows the owners to stay in the company and to keep the company intact while they're selling their interests in the company. It motivates and retains employees through ownership incentives. So because the employees are allowed to continue to own the stock, they are more incentivized to make sure the company is doing very well. And ensures business continuity. Legacy remains while the owners phase out. So it allows the owners to sell a portion of their stock and maintain some of the stock so that they control the business, or to sell all of their stock and still control the business. Okay. Now, the one thing that you do need to have with an ESOP is you'll need to hire an independent valuation expert who has to come in every year and determine the stock value. That helps set a share price for buying and selling stock within the ESOP. That is important because you need to be able to demonstrate that there is fairness in the value. An ESOP trustee is involved in the decision making in the ESOP. So the trustee will set the price and make sure that because they have fiduciary liability, that the price is accurate. They are not going to want to set a price that it's too low or too high. And that will protect the employees as well. You also want an independent trustee for fairness in the transactions. So it is very likely that someone will suggest to a business owner that they put in place a company executive as the fiduciary trustee. The problem with that is that typically when you go to sell the company down the road, that becomes a problem. If you're going to a third party for selling the company, a third party is going to want to insist that any fiduciary issues are taken care of by having a bank as the fiduciary trustee. The other thing is that you know there is a requirement under the code that you allow pass-through voting on the company's stock. The way to avoid that is to structure any third-party sale as a stock sale, not as a merger or not as anything else that triggers the stock voting requirements. Major tax advantages of the ESOPs are that the loan repayments are deductible up to 25% of covered comp with respect to loan repayments of principal. The interest deduction, the interest is deductible entirely. So that's why an ESOP is very beneficial in terms of you're able to deduct a loan repayment up to 25% of covered comp, and you're able to deduct the interest payments entirely. That is very beneficial because it's very unusual in any tax qualified plan to find that you can go out and get a loan and you can deduct the payments on the loan. The other issue that's very advantageous with the ESOP is that there is a deduction for dividends on the C Corp if the dividends are paid to the participants or reinvested in employer securities or used for the ESOP loan repayment. So you can deduct those dividend payments as well under an ESOP. An S Corp pays no federal or state income tax on the portion owned by the ESOP. So it's very beneficial for an S Corp so you might want to structure this if you're an S Corp owner to sell your stock to the ESOP, and then all the ESOP shares are totally exempt from income tax. There is also a 1042 election that an employer might want to take advantage of in selling his stock to an ESOP. And I'll let Bob talk a little bit more about the 1042 election and the effect that might have on estate planning issues.
What Moran was getting at here, which is important, that first bullet point, the tax deductibility of these loan payments. Because the ESOP is a qualified retirement plan, it's pretty interesting that it can take a loan from the company and then the contributions and then the payments back. You're artificially creating up to a 25% deduction on that. So the tax deductions here can be pretty staggering. And then also the S Corp comment below, where the income flowing up to the if it is an S corp share that is sold to the ESOP, the income flowing through on those S corp shares that are tagged to the ESOP, don't have the follow through, the pass through income on that, which is pretty interesting. In certain situations, this would be for C corps. So if I'm a business owner and I have a C corporation and I'm looking at selling my company or a portion of it, and I'm going through my options, and ESOP being one example here. And if I decide to follow through and execute on an ESOP plan and I sell my C corp shares that I have owned for at least 3 years, and there's a 30% requirement here that at least 30% of the company is owned by the ESOP. If I take the proceeds of that sale and find a qualified replacement property or a fund that qualifies as a replacement property, I can defer the associated capital gains or income tax on that transaction, which is pretty interesting. It's very similar to a like-kind exchange for a real estate transaction. For those that are maybe a bit more familiar with the 1031 exchange, where if I sell a piece of commercial real estate, that I bought really low and it's grown a lot, or I've depreciated down, I have this large gain, I can go through a 1031 exchange and buy a replacement property and at least defer my gain until I sell that replacement property. This is very similar.
So it looks like this is a terrific idea for a business owner that wants to get out of his company, because if he doesn't have employees who want to participate in the company, in fact, if he does have the employees, he can sell it into an ESOP and maintain all these terrific benefits. He can leverage the sale, which is a huge advantage. You can't do that with any other qualified plan.
Yep, 100%. And what was also interesting, which is the last bullet point here, in theory, if I were the selling shareholder of a C corp and I utilize this ESOP structure, I take my proceeds and I drop it into a qualifying replacement property or a fund that acts as one, and I hang on to that property or that fund interest until I pass, and I get a step up in cost basis on that replacement property. Well, I've eliminated the entire gain on that transaction of exiting those shares that I sold. Now, there are more factors to consider with that, as far as my overall estate planning, estate tax, both federal and state estate tax concerns, et cetera. But in theory, I could sell all or a large portion of my C corp shares, my company, defer the gain on that, get a step up in cost basis on the replacement, and then never end up paying income or capital gains taxes on that sale.
The one thing that you do need to worry about is there's a put option with respect to the stock. If you have a non-public company, you have to make sure that you create a market for those selling shareholders. So, for example, if the employees stay there at least 10 years and they continue to participate in the ESOP, and the ESOP goes out 10 years, then they can diversify up to 25% of their balance, their investment, their stock balance in the ESOP. That requires that the employer create a market for them to sell their stock, which is a very expensive for the seller. And it means that the owners of the company need to make sure that they have enough cash that they can generate cash to buy back the stock if that happens.
Along those same lines, in the 1042 election itself, any seller of any company in any circumstance, ESOP or not, in a perfect world would be thinking about, not just the actual sale transaction itself, but post-closing and how it affects their personal balance sheet and their overall, tax, estate, and financial planning. And so wanted to hit on that as well, but make it a bit more specific here today to an ESOP. We talked about the 1042 election and potentially carrying that forward and ultimately getting a step up in cost basis on death. A couple other just notes here. Charitable planning, just like in similar to another exit event, if I'm thinking about selling some of my shares, and there are rules and timing rules and other things to be mindful of, but I could potentially combine the ESOP sale with some charitable trust planning. And so we have clients that, are quite giving and charitable in spirit, and others that become a bit more charitable in spirit when they analyze the tax savings associated with it, like any situation. And there are ways to combine these planning. For example, I could potentially take some of my shares, drop it into a charitable trust, and have the ESOP buy the shares from the charitable trust. It does not work in every single scenario, but it's something that can be looked at and explored to avoid some of the capital gains tax potentially on the sale, and to provide a benefit to some charities, and combining that with my own personal estate planning. Also of note is the prototype ESOP comment up here. We'd be happy to write up an ESOP, or more so than I would be happy to write up an ESOP plan for you and spend an awful amount of billable time to do that. But over time, as they become more common, prototypes, or quote unquote off the shelf ESOPs, exist. So enough of this is being done, and certain institutions are used to these, where these plans can be put into place in a much more cost-effective manner than in years past. So just something to note as well that we wanted to make a point of today. Is an ESOP right for you? Maybe. And I think if nothing else, the takeaway here is just to be mindful that the ESOP, is an option for a business owner looking to exit. It's tax efficient if we meet the certain parameters and the client situation fits. It's a great way to reward and retain employees, because again, as part of setting up the ESOP structure, those employees will become the participants in the ESOP. So those employees, and as part of the design of the ESOP and how the employees come in and join, and what are the benchmarks to determine all that would be figured out. They're participants in that ESOP, and that ESOP owns a big chunk of that company. They'll be as motivated as you can get to drive the success and the value of that ESOP up. And the third check mark here is great. The gradual transition while maintaining
company,
by maintaining control, in the sense of, if I take a chunk of my company and sell it to the ESOP, even if potentially I sold all of my interest, I'm going to be as direct control, but it's not an outside third-party group that's coming in to take over. My existing C-suite team, my directors, my management team that I've been working with all these years, are now the incentivized folks that are becoming participants in this ESOP. So it's my team that stays in place. And I may decide to do that over time. Maybe I sell a chunk to the ESOP and I stay with them. But it's not like this third-party group is bringing in their entire management team, replacing my key people. Those are all still there. And so in certain circumstances, that is a big draw and a big benefit for a lot of people that are thinking about exiting their company.
The only thing with an ESOP is that it isn't a qualified retirement plan. So you have to be aware of the fact that you're going to have all the eligibility rules, put option as well. So you need to structure this and you need to plan for it. But we just wanted to introduce this to you as a potential option that you could consider. Yep. It may work for some, it may not work for everybody, but it's a great option.
So one of the questions here is, who is in charge of an ESOP, and how is that person selected? So at the end of the day, there's a trustee that's in charge of the ESOP, and the selling shareholders in the company,
is picked by the company,
right? That would, as part of the ESOP design at the outset, would figure out who that trustee would be. We've seen it different ways, where it's a key manager, a key employee, an outside financial institution, et cetera. And I think in most cases, our preference would be to work with an outside financial professional or banking institution to act as that trustee. There's liability.
That's assuming the company wants to plan to sell the business eventually. So usually there's an exit strategy that is planned for with respect to an ESOP. An ESOP is just an interim step. There is an exit strategy that is planned for the sale of the company to a third party. And that would require that you have an independent financial institution involved. The banks will want it because they want to make sure that they're involved and they're not dealing with the ESOP. The problem with the ESOP is that once you have an independent trustee of an ESOP, that independent trustee has to put the best interests of the participants forefront. So, for example, any management kind of side deals are not going to be allowed by the ESOP trustee. So you got to be very careful with the ESOP trustee. And you do have a third party involved in a sale of the company. You'll have the buyer, you'll have the seller, and you're going to have a trustee. So you've got three parties involved at any time.
Just feel free to reach out to Maura, Ann, or I. Just give us an email, give us a call, or if you just want to just generally just talk this through or clarify anything, we're happy to go through that. So thanks everybody for participating today, and have a great rest of your day.
For more information on our employment law services or any of our other practice areas, visit kelleherholland.com or send us an email to attorneys@kelleherholland.com. Kelleher & Holland's Employment Law Lunch and Learns are prepared for the general information of clients and friends of the firm. It is not intended to provide legal advice with respect to any specific matter, nor is it intended to create an attorney-client relationship. Under rules applicable to the professional conduct of attorneys in various jurisdictions, this may be considered attorney advertising material.